Good afternoon, everyone. Excuse me. My name is Jesus Nava. I'm the Director of Client Training and Education for TradeStation Securities. It's always great to join you guys to learn about TradeStation and learn about asset classes. Like today, we're going to highlight options and option strategies. And we're very happy to have Brandon Wendell with us today. He's an expert trader and also an educator, and he's going to share with us his expertise in just a moment. Just a little bit about this series. Options Replay is a series that we designed to help you with placing trades and understand the reasoning and the way that you find trading candidates and how do you can manage those trades and minimize your risk. So we do all that here and we talk about different examples. So we wanted to design a class that it was more from a practical standpoint than just plain theory. So we're glad that we have the series. It happens every 2 weeks. So make sure that you keep an eye on our schedule so that you can register for all future classes. So thank you for taking the time to be here and learn a little bit about this topic. Before I pass the microphone over to Brandon, let's go through some of the disclosures. Just keep in mind that every symbol and idea that we talk about is for educational purposes only. These are not recommendations of TradeStation. Also, that active trading is not suitable for everyone, and especially when trading with options, which carry a higher degree of risk. Past historical performance is no guarantee of future results. And if Brandon goes through some examples, just keep in mind that whatever happens in a simulator, very unlikely for it to happen in a real world. However, this is a learning experience. Also wanted to point out that even though we love to have Brandon here, he's not affiliated with TradeStation, so his ideas and presentations and teachings are his own. But it's a great pleasure to have him here with us. I also wanted to show everyone where to find these presentations. What you're looking at right here on my screen is the Options Education Center. In order for you to arrive here, you have to go to tradestation.com, hover over Learn, and you see Options Education. As part of the Options Education Center, if you scroll down a little bit, you'll see a banner for Options Replay. And if you click on Watch Previous, you'll see a history of all the sessions that Brandon has done with us, highlighting the most recent one. So the one in the bigger box is the one that happened 2 weeks ago. And if you scroll down a little bit, we'll see other examples of presentations that we've done recently. So if you haven't had a time to watch those, they're there for you to replay, hence the name Options Replay. So take some time to explore and see all the good things that we have here in the Options Education Center. All right. I'm going to stop my share and introduce my friend Brandon. Brandon, thank you so much for joining us today.
Yeah, thank you for having me. I appreciate it.
All right, I'll
Love
pass.
being here.
The microphone is all yours. Okay, take over.
All right, sounds good. Let me go ahead and share my desktop with you guys. So let me see screen one and share. All right, we are good. So welcome everyone. Welcome back for most of you, hopefully, been following us for a little bit. My name is Brandon Wendell. I'm a full-time trader and educator for the markets. As Jesus said, I'm an independent contractor. I don't actually work for TradeStation as an employee, but they've asked me to come in and kind of hang out with you guys because I'm familiar with the platform and trade on the platform. I have an open account there. And I'm in a simulated account right now. So we're going to be looking at the markets and really trying to get you familiar with the process of placing some of the strategies that you've seen or hopefully learned. The Options Education Center is a great resource to be able to learn a lot of the strategies, but trying to put the rubber to the road, so to speak, and putting in the actual positions becomes a little daunting at times for people who haven't really done it a whole lot or have only ever traded on single leg options. And part of the reason why we want to do multi-leg options and uh, trade that way is the way that it reduces our risk dramatically. I've talked a little bit about the Greeks before, and I'll reiterate a little bit about it as well. I'll go over here to my options platform here, which is OptionStation Pro. I happen to be on AEO, American Outfitters. Doesn't matter the security, and this is a short-term option right now, but we have Vega, Theta, Gamma, and Delta represented for the Greeks. The one I'm missing is Rho, which Rho is only important really when you're dealing with interest rate changes. But the Delta, D for direction, just a quick review, that tells you how much the price of the underlying security is likely to move based on a 1 point move in the, sorry, I said that wrong. The delta is how much the option premium is going to move based on a 1 point move of the underlying security. Okay, either up or down. We have positive and negatives. Negative means it moves opposite, positive means it moves with the underlying security. Gamma is a rate of acceleration, how fast delta changes. Theta is time value, it's time decay, so it's a negative, and every day options lose some value. I mentioned before that they're very similar to ice cubes. Ice cubes melt when you take them out of the freezer immediately, and the premium on options starts to melt immediately once they're created, and they go down in value until they're have no value, they're melted. So Vega is volatility exposure. And I said that's probably one of the most important things. We talked a little bit about this before, that when we're choosing what it is to trade, we may want to take a look at the volatility. I'll just take a random security Humana. Okay. I'm not saying it's good or bad right now. I'm not even going to look at the chart itself as far as direction moves. What I am going to take a look at is the volatility. And there's some resources and tools that we can use to help decide whether or not we should be buyers or sellers of options. And I mentioned that typically when volatility is low, option prices are relatively low or depressed, and therefore they're likely to go back up. Well, we're very fortunate right now. Humana, and by the way, this indicator is just a normal indicator that's already built in. It's implied volatility, all options. And you can see that I have it set up, and the yellow is the implied volatility of all. I think it's the monthly options. Actually, what you can do if you're not sure exactly what it is, you go to studies. This is a really cool thing too on TradeStation. So if I go to add studies, and it should open it up. Computer's running a little slow. There we go. And implied volatility, all options. If you click on definition, you'll see the definitions of exactly what it is it's measuring, what it's showing you. And you can see implied volatility for all options trading for the underlying asset in the chart. So it's pretty much the overall, and it's weighted and non-weighted implied volatility. It's calculated every day for the end of the day, and it doesn't change. It's just a number that'll be there for the entire day until the next day. Okay, so I wasn't sure if it's just doing one series, but it looks like it's all options. And you could change it to different ones as well. Anyway, I just need to know the overall volatility. And there are other indicators that I mentioned as well. I'm not sure if I downloaded it on this computer or not. Yes, implied volatility percent CH. And that is available in the options education website as one of the tools. I believe it's in with the bull call spread the bull call spread download. If not that one, let me see. So bring up a browser, hopefully. Let me close out my other ones because I got too many things open here. So I'm going to speed up my computer a little bit. There we go. And we're going to get into actual placement of securities and whatnot. But yeah, there we go. You can see the downlink. Okay. Are they up? Yeah. So TradeStation.com. And under Learn, you'll find the Options Education Center. So yeah, we'll get the the link in just a few. So under the Options Education. Again, I'm running a little slow. Something's going on with this computer today. It's funky, but there we go. So I'm not sure which one it was under originally, but like I said, we'll get it separate for you. But my main thing is that I can see using those certain indicators that this right now implied volatility is relatively low compared to historic volatility. Okay, historic volatility, what this indicator does is it takes a look back at the historical volatility for the last 52 weeks, and it shows how implied volatility is in relationship to that. So we see that implied volatility is extremely low. It's in the lower fifth. 20% would be the lower fifth, 20 to 40 is the section 2, 40 to 60 is section 3, 60 to 80 is section 4, where implied volatility is relatively high and options are likely to be a little bit higher priced. And then we have 80 to 100. So right now, Humana is very inexpensive, theoretically. Again, it may not be, but we can now go take a look at Humana options. And I also could link this. I do actually have it globally linked. And the reason why I have it globally linked is it makes it a little easier when I'm trading. Say, for instance, I was in the bull call spreads workspace and doing a scan. If I also have my watch list, my radar screen globally linked, once I click on it, it would load into my charts, but also into that page where I could start doing the analysis as well. So quickly looking at Humana, I'm not going to trade 3-day options. I could, but I'm not going to right now. But we know that the volatility is relatively low on all options. Now we can kind of verify that by taking a look at the theoretical value. I'm going to go ahead and remove certain columns for now, just for our discussion. That's not the one I want to remove. I hit the wrong button. Very easy to do. But we customize the columns. There we go. And I can see implied volatility if we want, but we can also see skew. But I want the theoretical value. There we go. That's the one I wanted back. And I'm not going to worry about gamma as much right now. I'll leave the rest. So there we go. So I'm going to focus primarily on this volatility as well as theoretical value. We could see, remember, we saw that Humana had relatively low volatility. And I said that implies that there may be low prices on the options. Well, take a look at the theoretical value of the at the money option at 280. It's only less than $5, but what's it priced at right now? You would buy this at 680 or 610. That's actually showing that we would be paying more than the value. Now, it may be thrown off again because I'm using a very close to expiration option, but that's the point. We want to make sure we're not overpaying for things. We got all these sales coming up, Black Friday, today, Veterans Day. By the way, thank you to all my fellow veterans. I appreciate your service and your sacrifices. So right here, we can see $2.38 is the value, theoretical value for the put at 280, but it's trading at 430 to 370. You don't want to buy something that's that overvalued. So let's take a look a little bit further out, perhaps. Let's go out, I don't know, 66 days here to January and see what we're looking at now. Again, just because implied volatility is relatively low doesn't mean you're getting the best price. Theoretical value is 1682. We're looking at $19 to $21 right now. Granted, the spreads are also very wide because the market has closed. Okay, so this is a little bit skewed and will correct itself when the markets are open. But even here, value for the puts, $12. I'm not paying $5 over value. No, thank you. So maybe we're going to look for a selling opportunity instead. Okay, so if I'm looking for a sell opportunity, let's say hypothetically I'm bullish on Humana. Again, completely theoretical. This is not a trade simulation that I'm trying to put out there. It's not a recommendation because I did not do the analysis on the chart. Okay, that's a key thing. But let's compare the two and see what happens. Right now I know that just looking at theoretical value, these options are most likely overpriced, overvalued, right? You'd be paying too much. So if I was bullish, there's two types of vertical spreads that I could do. Typically, I could do a bull call spread or a bull put spread. You'll see if I go back to my TradeStation here. There, I had it. There it goes. I actually have those workspaces open. Bull call, bull put. Actually, that's the wrong one. That's diagonal. So that's a new one. Put the wrong one. That's okay. But anyway, you can do searches for them, and the instructions on how to do the searches and what the studies are is all on that web page where the workspaces are downloadable. So for instance, again, if we go to, I'll do bear put right there. I know we were talking about bull put, but I'll just do the bear put because it was right in front of me. So if I select the bear put, it'll give you the information about the trading opportunity, the strategy itself, how it works, and of course the video as well. Explore strategies, download workspace, and in with the workspace, when you go to download, you'll see it should pop up. Nope, it's in a zip file. If I open that, I might not have opened it correctly. It should be going to, let's see, downloads. There we go. Yeah, that's what I wanted. Open the file location. Oh, it's on the other page. That's why I didn't see it. It's my other monitor. Inside, should show it. Yeah, workspace instructions. So in those instructions, it'll talk a little bit more about what the scans are and what they're there for. What are we actually looking for and how to use that? Okay. So if you have questions, of course, let us know. But basically, going back, if I want to do a bull call spread, it's very simple to select more than one leg. If you want to do it all at once, that's available too. I'm personally like building my strategies myself. I know a lot of people want to just go in and say, okay, I'm doing a vertical spread. I'll select vertical for the spread type. You'll notice on the option chain, it automatically changed. Again, I'll show you in case you didn't catch it. Here it's showing one strike. If I do a vertical spread, now it will show two strikes. And you can decide the difference between the strikes under the filters. So if I go to my filters and click the down arrow, you can see spread width. How many strikes do I want between the one strike and the next? Do I want a small amount? Do I want a large amount? It's entirely up to you what you want to select. So right now I have it set at 5. That means between each of the strikes, oops, didn't mean to click that. There we go. You can see between 280, we have 5 strikes, 280, 285, 290, 295, 300, 305. There are 5 strikes between the first and the second strike. Ah, there we go. Thank you, Jesus. I knew he'd find it for us. Anyway, if you want to adjust that, you can. The problem is, I may feel I want to try some different ones out. And instead of having it already set, I can individually select my own spreads this way. So if I'm going to do a bull call spread, let's say I pick the current at the money spread, I'll just click on the ask price in order to select that. And then just select the one I want to sell. Let's say I want to do 300, not the 305. I hold down the control key and click on the bid price. And you notice it just added in, and the computer recognized it as a vertical spread. If it's some kind of weird spread that you're putting together, it might just say custom. Otherwise, if it recognizes it, it'll put it as calendar, ratio, vertical, whatever it may be. And you can see there's a lot of different spreads out there. And they're all going to be getting covered in the Options Education Center, which is pretty cool. Okay. So again, if I decide I want to do this bull call spread, I can go ahead and put it together leg by leg. But remember, all I have to do, click the ask for where I want to buy, and even shows you buy next to my cursor, and sell when I hover before I click. To click more than one security, you have to hold the control key down. Watch what happens if I don't do that. If I go back and I wanted to buy the 280, I want to sell the 300. Oh, wait a minute, what happened to my 280? Well, it doesn't know that I wanted to do a multi-leg strategy because I didn't hold down the control key. So it deleted the other one. I could also delete this one if I click on the buy. Now it just went back. So again, I want to sell the 300, buy the 280. I hold the control key down to get another leg. If I wish to add another leg, I hit down the control key and click again. It's not a big deal. I could do that for multiple legs. So that's the bull call spread. And now I'm going to analyze that spread. And actually, before I analyze it, let me go back. Options, the tree key. Oh, I should have kept it on. That's okay. I'll do the mid. That's fine for now. So let me go back to where I was. Analysis. There we go. And I can do my analysis now to figure out, okay, well, normally before I do this spread, I would do my analysis on the underlying security itself. And I would try to determine, okay, I'm bullish on this security for whatever reasons. It might be in a bullish trend. I expect because it had good earnings or something good about the security itself coming out, that's going to continue the overall trend. Perhaps it's just simple that the market as a whole is rising, and this has a very good positive correlation with the S&P 500. So for whatever reason, I'm bullish. But I also go a little bit more than that, and I figure out, okay, not only am I bullish, but I know by next 30 days or so, we're likely to move up to a certain price. I know most traders do something called support and resistance. I trade a little bit different than that. Maybe we'll talk about that sometime, but I use what's called supply and demand. And that kind of goes back to when I used to be a professional trader for a brokerage and for a hedge fund that I manage. I use those key areas to identify where there's unfilled orders from institutions and where prices are likely to change in direction. So before I go to this step, I've already done my analysis to know where's my level of support, where price is not likely to go below. Let's say it's 280. So I'll bring this up. Oh, 280, and I can use the price slices to figure out what might happen if prices go to certain areas. And I know my resistance or supply, again, I don't use resistance, I use supply. And let's say that my supply level that we're not likely to rise above is about $304. Well, I got 390, it was pretty close. There we go. I'll use those numbers to kind of guesstimate what's likely to happen with the options in the future. And the nice thing is, I can look at last prices. I can add more price slices to make some more scenarios and figure out, okay, where did I break even? Now, if you're not familiar, there are these lines on the chart. There's a visual representation of profits or loss. Okay, you see right here, theoretical value, P&L, and you can change the chart to others. I typically just use it for this. And you notice there's two lines. This yellow line, it says 0 DTE. That is the expiration date and the plot, or basically the profit or loss of that particular option spread on the expiration of that particular strategy. Now, we're probably not going to hold this till expiration. The reason why is right here. Theta, time decay. Going back, this has a time decay of 15 cents on each option, or $15. Okay, you got to realize every single day, let me see, calculator. There we go. Let's say, for instance, on the higher price one, 15 divided by 2180. It's not a huge amount, but we're losing a little less, a little more than 0.5% per day just for holding. That's how much the ice is melting on that security. And it's actually going to increase. Exactly. Maurice just said the ice cube is melting. You got it. You know, it's melting at a little over 0.5% a day, but that's going to accelerate the closer you get to expiration. Again, I'm using the 280. If we go half the amount now, 280, we went to 21 cents. So look at that, 21 divided by, what is it, 16? Yeah, 16 bucks even. No, that's not right. $21 divided by 1600, that is 1.3%. So instead of only melting at 0.6% per day, now it's melting at 1.3% per day. Okay. So you're actually seeing it melting a lot faster the closer you get to expiration. And it can get ridiculous. That's why you want to make sure when you're buying options, you buy time. Yes, they cost more, but look at this theta, 64 cents on 680. That's crazy. There's only 3 days left till expiration. So 64 bucks divided by 680. That means that's melting at almost 10% a day. 9.4% is melting. That's one of Elon's flamethrowers being blown on that. Anyway. All right. So again, I'm looking at this trade, going to the analysis, and I can look to see, okay, I brought this up because I'm not getting out on the day of expiration. I am buying time, and actually I may not have bought enough time. That's the other thing I want to take a look at. I can see that right now I'm paying $795 or $7.95. You can tell right there, there's a price, there's my max loss, $7.95. Okay, remember every option is 100 shares. We're trading stocks or trading on indexes or ETFs. If you're trading futures, well, you've got to watch our masterclass workshop. We did that on options futures, or futures on futures options. Anyway, so right here, I'm going to be getting out early, and I can kind of gauge where I might be getting out. I typically want to exit when there's at least 30 days left until expiration of the option. Okay. Sorry, I have a brace on my arm. I was delivering hay yesterday, so hauling bales of hay. Long story. Anyway, so getting back to this, I may exit, and I can use this little cogwheel to change. Okay, the cogwheel brings up the menu for the settings of the chart. I go to graph, and right here I can choose what other dates do I want to examine. This right now is set on the current date. If I add another day, I can go to halfway to the expiration. That would give us, and you can see right here, if you focus on this little box area here, you'll notice the dates change. See how the dates are changing? So I can see there's 33 days left. Let's go push it to 30. That's about it, because I don't want to go inside of 30 days. The reason why, that expiration or melting accelerates when there's 30 days or less till expiration. So I want to be out of the position by that time. You can see the faster it moves, the more money we'll make. If it moves to the upside, we'll lose, obviously, if it goes down. But time also changes how much we're going to make or lose. So if we were to hold till expiration, we'll definitely make the most amount of money, but we start losing some of the time value if it doesn't happen fast enough, if it doesn't move far enough and fast enough. You can actually see some of the time value eroding the value of that security. Okay, the security being the option, not the underlying security. And again, what is going on here? Sorry, checking something. Oh, okay. Close that. Same, my computer's running slow, so I'm trying to speed it up by closing things. There we go. Anyway, so we can take a look at this and say, okay, if I'm going to put in this bullish trade, I'm expecting prices to rise. If they do rise to my target, obviously, once it goes past a certain point, I'm not going to make any more. But if it rises to my target before the expiration, let's say we go to day or plot 3, which is the green. It's nice, it's color coded. Green is not now, not the 0 DT, but 30 days till expiration. It would actually be December 18th. So if we get to my target by the 18th, 304, you can see the theoretical value and how much I might profit. Again, this is all theoretical. So if this happens by December 18th, my expectation is that we get to 304. Let me write these numbers down because I'm going to use them as well for comparing a different strategy. All right. So again, I'm using options that expire in January. I use the 280 and 300, excuse me, and it was 795 to get in. I'm expected to profit roughly $477. Now, there are other factors that are going to change, and we have to look back to see what normally happens in the market environment. If volatility rises, remember, one of the reasons why I like this in particular for buying was that volatility is relatively low currently. You can see, based on this gauge, it's relatively low, and or if I bring in implied volatility, all options. We saw that as well. Nope, that's the wrong one. All options. Here we go. I changed my default. We can also see, yeah, implied volatility is extremely low compared to the average. This is implied volatility. This is implied volatility. Notice they're the same. But this is showing it versus historic volatility. This is showing it versus itself, an average. That's the difference. So I found that volatility is relatively low. If it rallies, let's say it rallies just to the average. Now, the average will be coming down, okay? But we're right now at about 34, we'll call it, we'll round. And it may rise to, let's say, 50, okay? So 34 to 50, we're looking at what, 16 points? Is that right? 16 points of volatility. What happens if we go up 16 points of volatility? It changes things, doesn't it? It actually cuts the profits a little bit too to 361. Okay. Now, if we go a little too long holding on, what will also happen is that volatility rising can hurt us as well. So let me take a look. If we do this, again, you can play around with the numbers to kind of see if this happens, what then? So we were currently at $361 profit. If we hold too long, let's see what happens. Well, holding on longer actually benefits us a bit as the volatility effect wears down a little bit more. So in this case, it might be advantageous to hold as long as possible unless prices start falling against us. So once they hit our maximum profit, which is the option that we're selling, we can't make any more after that, at least at expiration. Before the expiration, we can continue to profit as prices move up. The further, the better. But if we're likely to see a turn down, then obviously we want to exit with the profits that we can. Okay, so we were looking at roughly $477 when I did the volatility adjustment. Again, let me pull this back to the right date. And that is, I did 30 days. There we go. we're looking at about, wait, oh, yeah, 361. That's right, because I did the volatility adjustment. 361 volatility. Okay. And now let's compare this. I'm going to go ahead and I'll keep this one here, but I'm going to go create a new spread. And instead of using the bull call spread, let's clear it. I'm going to do the bull put spread. Because remember, there's two different ways of doing this. One is bull call, the other is a bull put. And I click the 280 and I'll sell. Let's see, we did a 20-point spread before. So 280, I could do the 260s. I'll buy the 260. That's a bull put spread. I'm selling the put and buying a cheaper put. And now you can see my max profit is $785. Well, here's the other thing. I might not choose this option because I need this to expire for me to collect 100% of that premium. Well, I would rather have that ice cube with the blow dryer or the flamethrower on it, right? Oh, how do you close out of the spread at some loss or profit? Actually, before I go to this one, let's do that. That's probably a good thing to look at, okay? So what I'll do is go back to the original one, and that's actually a really good step. Thank you, Ed, for bringing that up. So go back over to the analyze. Actually, I analyzed this one for now, just to get to that page. And take it off. There we go. So this one, I don't think it'll let me put the trade in right now because the market's closed, right? Actually, if I do it as a limit, good till cancel, it should. Because it'll put it in for the next session tomorrow. It's not a big deal. Okay. So that is the bull call spread that I was just putting in. Now, let's say we're already in the bull call spread. And as Ed was saying, okay, well, maybe we made it up to our target that we know prices are likely to bounce back down, and maybe it happened quickly, right? Perhaps we got up there and move this down, and it didn't take till December 18th. Let's say it only took, let's pick a random time, December 3rd, okay? So we got to our target on December 3rd. So I changed my dates to December 3rd just to show you a scenario of what it would be. On December 3rd, if we got to, let's say 296, or we'll get closer. Yeah, let's say it hit our supply and starting to turn down now, and we want to lock in our profits, or we're worried about a loss as well. Okay. Two things we can do. One, for this, we can manually exit very easily. If I know that, okay, I'm still up $221 and I'd like to lock in that $221 profit, by the way, that's a decent return. You got to realize we only use $795 to get in. So 221 divided by 795, that's a 27% return, 28%. But if we want to simply exit, that's easy. You go to your manage position or manage tab on your options. For instance, I have an option spread. Oh, it's a single option here. You can simply right click, close this position, and it will load up your trade ticket with a limit order at current price, or you, of course, you can simply do a market order to get out. Now, instead, let's say I want to get out of this. Let me go ahead and minimize that one. Let's do a vertical spread because I know I have one here. I think Campbell's, no, that's a back spread. ConocoPhillips, diagonal. Diagonal, I have some more advanced strategies I'm working up to with you guys. FNF is a single, smart, strangle, Verizon single. Thought I had a, I guess I don't. That's okay. I'll just use this strangle. If I decide I want to get out of this strangle, and this is something we can do once we have entered in the position. So hypothetically, let's imagine we put on that Humana spread. Okay, we did the bull call spread, or it could be the, whichever one, doesn't matter. You would go to your manage page and see your open positions. And just like I did, you would right click anywhere on the line. Okay, it's got to be on the actual position because you might have multiple positions. And if I click here, it's not going to work, but I'm right clicking on the position I want to close, and you go to close this position. Okay, so let's say I want to close that straddle out. I go there, right click, close this position. It brings up the order ticket. Now, what I can do, which is pretty interesting, I can go ahead and exit not based on, hey, I want to lock in this particular profit. We can guesstimate how much profit we're going to have. Okay, now I'm going to use this position because I have actually, no, I won't. I'll do it right. Let's go back. And this Humana spread, I'm going to do create opposite order. That would do the same thing as exiting. Okay, remember, I entered my position, hypothetically. I would instead go to my position, right click, and analyze close, or not analyze, sorry, it's just simply close this position, okay? And what I would do is, first of all, on the analysis page, the original position, you minimize the trade tab, and this is the right one, yes. On this position, we are having a max loss of 795. Should we lose 100%? No, that's not really smart. Theoretically, we realize that if I get out when there are roughly 30 days left till expiration and the volatility increases, let's say it increases, I don't know, 11%, just making up some random numbers, doesn't quite get to where it was. And we got to almost to our target, or actually to our target. Okay, so we get to our supply zone where I expect prices to turn down to around 303. I think that's where I had it before. I know how much I potentially will make, right? So let's just make it easy. Make it 300 bucks. Okay. So I know that I will profit approximately, remember, this is approximate, it's not exact, but I will approximately profit $300 at 298.91. We can call it 299 really if you wanted to, but 298.91, I'll make about 300 bucks, which is a pretty good return, isn't it, on a $795 investment? You know, again, percentage wise, you can figure it out. 300 divided by 795, 37%. I'd be happy with 37%. Now, how much am I willing to lose? Typically, rule of thumb, I don't want to lose more than 1/3 of my potential profits. So I want to lose no more than 100 bucks. Well, by that time, what should price be where we would call it quits? Well, I just keep moving this down. And again, it won't be exact, but we can approximate how much we would lose or when we would lose $100. And by the way, if it happens sooner, let me just change this. We're not from the front or current price, time. Actually, it already was adjusted. That was at 66 days till expiration now, basically. But let's say we go maybe a week or so. What was I here? 66, we'll go to 59. That's 7 days later from opening it. So by November 19th, you'll notice that to get to a negative 100, go to plot 2, we're going to have to go further. So if we get out and lose 100 bucks, look at that. Prices have to go much further for us to lose 100 bucks, don't we? So it's actually in our favor. The longer we hold on, the faster we can lose money. Remember, that's that time decay. So let's just say, I can go ahead and use this about a week, or let's say 2 weeks from now, just to be safe. I don't want to get out too soon and have my stops in the wrong spot, but I can go maybe 2 weeks from now. So it's 59, so we'll go to 52. There we go. And it doesn't have to be exact. You can even do now. Okay, I'll do it both ways. Right now, or not now, there we are, $100 loss. Boom. There we go. So I'm expecting to hit my target within 30 days left till expiration. So about 36 days from now. And my potential profit was about $300. I would lose $100 if prices of the underlying security drops to 275. 275. Now, do I have to do that? No, I could use the current price rather than having to, or sorry, current time. So again, going back to my graph, leave it at, I'll use, actually make it easier to see, the yellow. There we go. Right now, for us to profit $300, prices need to move there. And actually, let's do it minus the volatility. We'll just make the volatility a bonus. So again, if I want to make 300 bucks, I need prices to rally to approximately 301. And that's where I'll call it quits. Before it was about 298. We really didn't have much of a change. So roughly 300 bucks. Now, how much will I lose, or where would price have to go for me to lose 100 bucks? Roughly 276. Again, it didn't change much. It was at 275 before. So now it's 300 and 276. That's where I will either hit a profit of roughly $300 or I would lose roughly $100. I'm willing to risk 3 to 1 or risk 1 to make 3. Does that make sense? All I've done was when I'm looking to get into the trade, I look at my chart, my analysis, and I identify theoretically how long do I think it's going to take to reach my target and what is that target price? Where's my supply? And I can figure out how much I'm going to make, divide that by 3, and then figure out what price would I lose roughly 1/3 of my potential profit. Okay. Now that I've done that, I go to my exit the trade. Again, you could do this once you're in the position only. Now that I'm in the position, I go ahead and I decide, okay, great. I want to exit if this goes against me. Let me clear this real quick. And start fresh. So there I did my analysis. This is the actual position I'm looking to do where I'm going to buy the 280, sell the 300, right? All I have to do is on that position, which would actually be in the manage tab, I would right click and put in close this position. In this case, I'm going to do analyze opposite trade. Let's see, is it analyzing it? It didn't put it in my trade thing, did it? That's okay. I'll just put trade. And there's my trade, but I'm just going to reverse it. That's all. So initially I sold the 300, bought the 280. And yes, we're going to do an OCO right there. So now I'm doing the inverse. Now, normally, like I said, if you went to the actual open position, right clicked and said, close this position, it would automatically fill this out for you. It would show you exactly what you need to exit. And what I'm going to do is put in a market order to exit. Okay. Market, because I just want to get out. Now, this is only an approximation. I may end up losing more. I may end up making more. Okay. We don't know exactly what option prices will be in the future. We use theoretical models to figure out what they're likely to be in the future. So I'm going to use this tool right here called activation rule. Okay. And there is a section in the Options Education Center that talks about this, but we'll practice. So in this activation rule, I click the little ellipsis button. That's the 3 dots. And I say, okay, based on my analysis, if Humana goes up to or equal to 300, I would like to exit. And I know I'm likely to make around $300 profit. It may be more, maybe a little less. It's not going to be exact. We can't predict that exactly. This, by the way, trigger type, again, if you go into the help and definitions, they'll give you more details about this. Sometimes it's not so much happening as much now as it used to, but what would happen is these people called market makers who create liquidity in the securities, they would hold back orders or hold back trades that have occurred and try to trick people and throw in the orders late to trigger stops like this. So to protect yourself, you can say, okay, I only want this to trigger my order if we get 2 trades that occur within the national best bidder offer. Is it necessary? Maybe, maybe not. It will protect you. It's an extra layer of protection. So that way you don't get hit with a late or early, it's called a late print, and it would be an early stop out. Okay, so we only want to exit when the trades have actually occurred at that time, not because they're late prints. So using that actually protects you. It's a nice thing a TradeStation does to protect you. So in this case, what we can do, yeah, Maurice is saying using conditional orders to exit. Absolutely. This is one of the best ways to do it. So if we hit our target, we know we're likely to make roughly $300. We will get out if prices reach our underlying securities price target. Now I'm going to put in the stop loss. And you got to be very careful. I hit add once again to add another line. You got to change this from and to or. You can't have price in two spots at the same time. So make sure you change that. I've seen that mistake made so many times. You change from and to or. And again, I can do the NBBO thing. But we want to get out if prices are equal to or less than 276, because that's where we determined, it's 276. That's where we determined that we would lose roughly $100 in that position. So unfortunately, I can't set it based on the premium of the underlying security. That'd be kind of nice too, but yeah, I can set it based on the underlying value, and I can it kind of estimate what the underlying value will be when they get to certain price levels. So by doing that now, and I place the order, it is placing a stop loss and an exit if prices get to my target, or if it gets below a certain level where I'm cutting off. I don't have to lose $800. I can limit the amount of loss. So again, kind of practicing this, if I go back to an actual position that I have, let me take off the analysis stuff here. I'll just clear this whole up, start fresh. Because this is important stuff to know. You should, even though, on a debit strategy like I'm doing, my max risk, I cannot lose more than what I paid for the position, right? But why do you want to lose that much? If you're wrong, get out with what capital you have and use it somewhere else that's going to make money. We don't add to losers, we want to add to winners. So if I go to my manage tab here and I have a position that, I've got several positions here that I don't actually have an exit for yet. This one's kind of nice, AXON. I'm up about 13 grand on one side, 14 grand on another. These are 420 straddles that I put on a while back. Pretty good winner there. Don't worry, we'll dissect the straddles and figure out what's going on there too, and the strangles. But let's say I want to exit this. It's obviously a little late. I don't want to mess with that one. Let's do this straddle. It's negative right now. That's fine. I right click on the position. Anytime you get in a position, you go right click, close this position. Okay. Now, I obviously should have done underlying analysis on this position. So BEN. If I go back to the chart, BEN. This is a straddle that was put on, correct? Yes, I straddled it at $20. Actually, when's the expiration? January. So we've got a lot of time left on this. But it was a straddle at $20. Basically, what's happened is Ben has been stuck at $20. And I don't know, I think there might have been some sort of a earnings announcement or something coming up. Let me see. And study. If you go to, I think it's under N for next earnings. Oh no, earnings per share, I think it is. I forget the indicator. There's an earnings release indicator that shows you. Oh, it's a show me. That's why. EPS postings. I don't think there's a next. Yeah, it's EPS postings. So adding that on, there we go. We see there was an earnings here, and that was July 29th. So July, August, September, October, November, there should be an earnings coming up. Okay. If you use the OCO, okay, great question. OCO on a different platform set loss as a stop limit based on the short strike being hit. Yes, you could do that too. Sure. You can put it as a short strike, and I'll show you in just a moment. So again, if I'm looking at this, well, this is the same strike actually for both. But yes, you could do it. Next earnings date, was that one of the indicators? It should be. Add study. Does it show me though? I can't remember where it is. There is a next earnings date. Thank you. There it is. Next earnings date. Indicator. All right. But yes, remember how I put in next earnings date? Oh, they just had earnings. So it just hasn't posted the EPS yet, but they must have just had earnings. That's why I had that straddle on there. And it didn't work out because we didn't move far enough, but that's okay. Anyway, that was the idea, was to place that trade based on the movement. And I'll go but dissect this one later with you guys. But two things first before I go forward. Using the OCO, yes, you can put it based on the prices hitting your target of 300 in my case, or going below the shorts, or hitting the short strike. Sorry, that was your profit, right? I had 300. I could set it for that rather than where I would expect to make $300. If I expected to get to a certain strike, and I want to exit, yes, you can do that. You set it on the strike. Now, this one, again, with BEN, let's say I wish to exit if I lose a certain amount of profit. Again, I go to my position, I right-click, close this position. To exit, we don't want to mess around with limit orders. You could, though. If you want to make sure you exit with a certain amount of profit or a certain amount of risk, then you can put in that limit order if you choose to. Okay. For instance, if I know I want to exit once I profit, I don't know, let's say $500. Okay. If I am getting a credit 260 right now, well, basically I'm only collecting 260 bucks. I can't do that much. But let's say I want to make at least $100. Okay. I can go ahead and set my order, buy it back. Okay. When I hit a certain price, and the also a limit order, or actually just a limit order is all you really need in that case. But what I'm going to do in this case is set an order by using the activation rule and a market. Okay. So let me take a step back. All I have to do to exit, right click, close this position, or bring up the order tab. If I know I'm going to set my target price, let me just do these independently. If I know I want to get out, I can just set a limit order saying, okay, if it costs me 160, I'm going to exit. Okay, it's not going to fill right now because the price is totally different. It's at 260 right now. But if I can buy this to cover at a smaller price, buy at 160 or better, then I will close this position once we get there. Hit yes. Oh, sorry, forgot I have to do GTC. So it'll work on the next day. That basically means that if I put in this order, if I get filled, actually don't even know what my actual collection was. This is just showing what the prices are now. But if I put that in, if I bought it at 160, let me see what the actual credit was. Oh, no, this is a long. Never mind. This was a debit that I did. It was the January's right here. Price was 260 when I bought it. So right now I'd be taking a $100 loss. Or is that the price is showing now? No, it's the current price. Trade price was 295. There we go. So based on that, if it was a debit, I would put in a sell order to exit, okay, at $1 more than that, $3.95. By doing that, I'm going to sell at $3.95 or better. That means I'm going to wait to get out until it hits my profit. And once it hits my profit target of $1 or $100, I will exit. And I can place that order, again, good till cancel with the limit, and that's my target. Okay, what did it say? Yes. Oh, it should be a credit. Anyway, I can put that in to make my profit. And then I can also put in the market order with the activation rule. And if prices get to a certain level, it really doesn't work too well on the straddle. It's more on the vertical spreads I should be focusing on here. And if we want to get out when we reach a certain level, that's all I have to do is put in price. And this is BEN. Okay. And if prices go down to a certain level, I want to exit. And I can guesstimate how much I'm going to lose and set that price based on the chart that I was using under my analysis. So again, I apologize. I don't think I have an open, I thought I had a vertical spread open somewhere. Strangle? Might be on my other account. I apologize. It's really weird. Here's a vertical. So I knew I had one. There we go. AEO. So in this case, close this position. There we go. AEO. Man, this is a losing position right now. The trade price is actually 282. So this is a good example I could use on AEO. Okay, this was entered. I have to check exactly when, but it is a vertical spread. What's the current price? Underlying 1821. So this was a long 18 call. It's a bull call spread, I believe. because we're selling the 23 higher strike, buying the lower strike. So this is exactly what we're looking at. Although putting it on now would probably be better than it was here. Anyway, at the time, looking for a bull call spread. So if I went to exit this position, again, I just do right click, close this position. I have it up. And I would do this much closer to entry. Now, I wouldn't necessarily want to do it right now. You can see that's only $1.40. Entry price was $2.82. So it's already negative a bit, $141, $1.41 basically. But at the time of entry, let me go ahead and do this. Analyze duplicate. There we go. This is not the exit. This is the actual position when we were getting in. Graph. There we go. Halfway and now. So that's what the risk profile looks like on that particular security. So hypothetically, if we expect it to get to 23 bucks and we want to exit when it hits our resistance or supply zone, we can just place that limit order. Again, I would go to my position, manage, right click, close this position. There's the order. I put in, I can just do market. Basically, that'd probably be the easiest thing. Market, activation rule, exit if AEO gets up to or equal to 23, which is the short strike right there. That's it. Once I hit my target, I'll get out. How much will I make? It depends. I can estimate how much I'll make depending on when I think it might happen. So based on my underlying trade analysis, AEO, I can kind of figure out how long it would take to reach to my target of 23. Right now, it seems very improbable, but hey, that's the way it goes. But what I could do then is on my analysis page, use a price slice, enter slice here. And let's say it happens halfway there, about 19 days till expiration. If we hit our target within the next 20 days, then my theoretical profit should be about $256 right there. So if I know my profit at that target would be roughly 200, actually, let me just get the right one. There it is. 255 bucks if we hit our target. So now I know I stand to make roughly 255. Okay, great. 255 divided by 3 is 85 bucks. I shouldn't risk more than 1/3 of my potential profit. So we'll add a slice, or actually I could have kept it where it was. That's fine. I can't change these individually right now, but that's 0. I want to go to now. And I just said it was what, 85 bucks potential loss. Let's slide this back to 85, roughly. That's pretty close, 84.95. And what price are we at? 1603. So if this drops to 16 bucks, I will lose $85. Now notice that's if it goes to expiration. If it hits that beforehand, I won't lose as much. Let's say it hits that. I'm going to plot 3. You can see I actually would lose more, showing my loss. How's that more? The green line shows less. That doesn't make sense. Oh, no, it is. I was at now, wasn't I? Yes, that's why, because I was at now. So if it happens later in time, it's going to be more. So I could adjust for that and say, okay, instead of waiting until 16, because there's time value, remember that time value is eroding. So I could say, all right, in 20 days, if it drops below 17 bucks, I want to get out. I can go back to my order. Okay, again, activation rule, market. The first one is single trade. If it hits my target, that's my short strike. Now, AEO, add, or if we go less than or equal to 17 bucks. And of course, don't forget to change that to or. So now I have a target and a stop on my open position based on that vertical spread. Hit OK. Now it's a market order, so I can only do this during regular trading hours, I think. It might let me put it in now. Place order. Let's see. And
order rejected.
Yep, it was rejected for some reason. I'll have to figure out why. Maybe because of the time of day and stuff. But basically, let me go through those steps again, just so you're a little more familiar. And this works the same way on any of our vertical spreads, really almost any trade, but I'm focusing on a vertical spread. Once the order has been filled, okay, that's the key thing. You can't put in the order ahead of time, but once you've been filled on that, the multi-leg, in this case, vertical bull call spread at the 23 and 18 calls, I want to protect myself and I don't have to worry about it. I want to be able to exit when we hit our target or if I lose a certain amount. What I do is I go to the position, I right click, close this position, brings up the order ticket. I can go to analyze. Actually, I should be analyzing the actual position first. So there I go, analyze the actual position. And figuring out approximately how many days it might take to reach the target, I found that I would profit roughly $255 if we reach $23, which is the upper strike. And that upper strike caps my maximum reward. At expiration, I cannot make any more, even if prices go higher than that. So I know my maximum potential reward here is about $255, theoretical. Okay, again, volatility could change a little bit, things can change, but I can't make more than the difference between the spread minus the premium collected anyway. In reality, I'm not going to make that much. That's what, $359.50. I'm not going to make that much. Okay, because I'm probably not going to get there and hold on to it to the end of the expiration. Instead, if it hits my target, there's a high probability prices are going to move back away from resistance. So to maximize the amount of profit I'm getting out when it hits my strike that I sold, and I'm likely to make around 250 bucks. Divided by 3, we found out that that's roughly 85 bucks. So I create another slice to figure out what price will cost me $85 in loss. And now I put in on the trade that I've already planned out. Oops, what happened there? On the trade, I bring up the activation rule. I do a market order. Now remember, the reason why I got this order the way it is was going to the manage page, right-clicking, close this position. There it is. I go market, activation rule. I want to get out if the underlying security, AEO, and I'll just hit it twice, change to or, if we hit our target of 23 bucks and we can protect ourselves, or if we go down to $17, which is where we would lose 1/3 of our potential profit. Good till cancel, place order. Yes, I place the order.
Rejected.
And again, it's I'll figure out why it's being rejected. I can look at the messages, but that's pretty much it. Again, I can figure out what kind of trade I want to put on based on volatility. We saw low volatility, so I decided I want to put on a long on Humana. Again, I didn't do all the numbers accurately, so it's not a recommendation. But for open orders to protect myself, we can place those stops. If we hit our targets, we just want to get out because prices are likely to move adversely. And all we'd be doing is killing time, hoping it goes back up. So we do that using the trade bar and the activation rule. And as I mentioned before, if you go back to the education, wrong page, there is actually on options education page, the options education center, a whole section on those activation rules that Jesus did very well. So I got to wrap this up. That's it for me for a little over an hour here. Any quick questions, let me know. Should have done the questions a little bit sooner. If there are not any questions, or if there are, we'd probably get an email for you guys, so you can email us, and we'll be back again in a couple weeks.
For sure, yes. Our email, by the way, let me just put it here in the chat so that everyone has it, is education@tradestation.com. And, if it's something that I can answer, I'll provide an answer. And if not, I'll reach out to Brandon so that he can help us out to provide you some direction. Brandon, that was great. I don't see any more questions here in the chat. So I think all the points hit where it should.
Thank you.
All right, Brandon, thank you so much for spending this time with us, Brandon, and everyone that attended this session. Also, thank you for your time and your support of TradeStation. Please check out the schedule for future events. The links are in the chat for you to access any recordings of this session, and I look forward to seeing you one of our future classes. Okay, goodbye, everyone. Great afternoon. Bye, Brandon.